Welcome to Accounting with Madam Ombi. Today we are going to look at control accounts. So we'll start by defining what are control accounts. Control accounts are so called because they control a section of the ledgers. Specifically, we are going to look at two types of control account. One of them is a sales ledger control account. Now, if you sell on credit, you resort into creating of debtors. So that is why this account is also called the debtors, Total Debtors Control Account. It shows the balance of all the debtors in an organization. Now, a control account is a totals account that shows all the transactions affecting a certain category. Now, when you talk about the sales ledger control account or the total debtors control account, it shows all the transactions that were affecting that category of debtors or customers or that resulted from sales. Then we have another type of control account, which is the purchases ledger control account. If you buy on credit, you resort into creating creditors. That is, if you buy on credit, you have not paid, then you create a creditor. So this is also called Total Creditors Account. So the balance of this account, it shows the total of all the creditors in the organization. That is the total amount owing to creditors in the organization or the total amount prepaid to creditors during in the organization during a certain period of time. So I want us to see why do we require to prepare these control accounts. So the purpose of control account, number one, is to provide a arithmetic check. We want to see if we take data A, B, C, D, all the debtors of the organization, and we add the balances that are in the accounts, then the total control account should provide an equivalent balance. So we want to check whether there is a arithmetic check on the postings made to individual customer accounts and the total as per the total control account. So that is just simply checking whether it is correct, arithmetic check. So you can also have a quick check, a quick way of getting the total balance that is going to be taken to the trial balance for both the debtors and also the creditors. It also helps us to detect and prevent errors and fraud, of course, because it also checks the accuracy of the clerks. And therefore, you can be able to detect if the control accounts do not agree with the personal ledgers, then they indicate that there is an error or there is fraud, which then can be investigated. Also, it helps us to determine in some scenarios where maybe you have incomplete records, you can use the debtors control account and the creditors control account. You can use them to either determine the purchases or the sales or the debtors or creditors figure, especially in cases where you have incomplete records. We are going to look at this. It is not part of the scope today, but you're going to look at how the control accounts can be used to determine the missing figures. So this is but just a quick check on what are control accounts or the purpose of control accounts. So before we come to the format of the control accounts, I would like to explain some few items here. As we have said, let us imagine we have many debtors in an organization. A debtor is also called an account receivable. This is a person who owes the organization money. That is a debtor. That is, it has resulted from selling to that customer on credit. So assuming that the debtor has an existing balance, the balance on the debtor's account should be a debit balance, like that. So that is the balance on the debtor's account if the debtor has an amount owing. That is, there is an amount owing from this debtor. But if the debtor has overpaid the account, meaning they have paid more than the debt in the account, meaning they have an overpayment in the organization or they have paid in advance, money in the organization, resulting into an account that shows a balance now on this side. So this debtor has overpaid his account. In fact, he has a prepayment in his account. This debtor has an amount owing that he has not yet paid. Now, when debtor A buys some amount of goods on credit, they have bought some goods and they have not yet paid for those goods. We are supposed to do what? We are supposed to debit the debtor and the credit sales. So we are saying this customer A has bought some goods on credit. So we have made a credit sale as an organization, because we are recording as the organization. We have made a credit sale. We are going to debit the debtor and as I've said, you are going to credit sales. This is sales account. You are just putting it there to complete the double entry. And you are going to say it was debtor A. Debtor A. Also, debtor B may also buy on credit. Once again, debtor B buys on credit. We are going to debit the account of the debtor with a credit sale. Then you are going again to credit the sales account from debtor B. So what happens is that now when you want to prepare a total debtors control account, or what you have called the sales ledger control account, we want to combine all these transactions from this debtor and this debtor into one account. So what you are going to do is that, number one, now you are going to come here, you want to draw a total debtors control account, total debtors control account. It is also called the sales ledger control account. We have said that already. It's called sales ledger control account. Now, from our two debtors that we have here previously, one of our debtor had a balance brought down on the debit side. This is a debit balance that represents an amount owing to the organization. It represents a debt because an amount owing, and one of the debtor had overpaid the account, so it represents an amount that is overpaid by the debtor to the organization. And we want to bring the two of them into one control account. Again, one has bought on credit while the other has bought on credit. So we want to combine the total credit sales of these two debtors into one control account. So our control account now, we are going to have one debtor having a balance brought down on the debit side. The other debtor has a balance brought down on the credit side. Then we have said we want to combine all their credit sales into this account, because they are the ones that are increasing the amount that is owing to debtors. Now in this control account, we want to see what is going to the total debt owing from our debtors. Now is the balance brought down plus the credit sales. What is going to reduce the amount that is due from these debtors? Number one, we can receive some cash receipt from customers, from debtors, cash received from debtors. So if we receive money from the debtors, remember, the debtors we sold to them on credit. If they pay any money, it is going to reduce the obligation. It is going to reduce how much they owe to us as the organization. So any money we receive, we are going to debit the bank, and then we are going to credit the debtor. Again, we can also receive some checks, so that we have checks received from debtors. Checks received from debtors. Again, when we receive some checks from the debtors, we are going to debit the bank with the money received, and then we are going to credit our debtors account. Again, we may decide to give the debtors a discount. So any discount allowed, it is going to reduce the amount of money that is owing from these debtors. So anything that reduces the amount owing from the debtors, we are going to credit to this account. So again, we are saying discount allowed. It is going to reduce how much the obligation here from the debtors is. We also have return inwards. So part of the goods that we have sold to them here on credit, the customers may return some of those goods. If they return some of those goods, then the amount of money due from them is going to reduce. So any return inwards, we are going to reduce the obligation. Again, return inwards is also called sales return, so it's the same thing. Any allowance to debtors. So other than discounts, if you give them any other price allowance that reduces the price, other than the discounts, we are also going to reduce the obligation or the amount of money that we are demanding from the debtors. Okay. If also some of the debtors become bankrupt and you have to write off the amount, so we have to write off the bad debts. So maybe some of the debtors to whom we sold on credit here, some of them have become bankrupt. So they are no longer able to meet the obligation. We have to write them off as bad debts. Again, the bad debt reduces the amount that is owing from these debtors. So you can also have bills receivable. Any bills receivable from the debtors or from their financial institutions on behalf of the debtors is going to reduce the amount of money that is owing from the debtors. So all these are items that reduce the obligation to the debtors. But now, some of the debtors to whom we have sold goods may also be selling to us something else. They may also be our creditors. Let me understand this. You are selling to a debtor. The same debtor is selling you something as the organization. So that debtor is a debtor because they are buying something from you, or you are selling something to them. At the same time, they are also selling something to you, meaning that they are also your creditor. So at that point, you may do what you call a contra or set off, where instead of you paying the instead of the debtor paying you, and then when you receive the money, you also pay them for the service they are delivering to you, you just cancel the amount that equals each other in terms of the debtor and the creditor. So you cancel out the amount in form of a set off. So this one is also going to go to the Creditors Control Account as a contra entry. Out of the items that we have put here, some of them may go back. Like let's see here, once you take these checks that are received from the debtors and you have deposited the checks into the bank, some of the checks may be dishonored by the bank. So what do we do if the checks are now dishonored by the bank? Remember, we had already credited those checks here and debited them to the bank account. So what do we do when the checks are dishonored? We add them back. So any dishonored check, any dishonored customer check, you debit. Again, if you had allowed a discount and later disallowed the discount, you are going to debit. So any discount that was allowed and now later disallowed discount, you are going to debit. Okay. Any bad debts that were written off and later on maybe the debtor was bankrupt has come back to business and now the debts are recoverable. So if they can be recovered, the bad debts again, if they are recoverable again after some time, they will be put back on the debit side, and so on. So one more thing is that you may also charge the interest on overdue account. On overdue account. So sometimes if you do not pay in good time, you may be charged some interest on the overdue account. So this is how a sales ledger control account will look like. Again, it is going to have balances on both sides. You're going to have the balance carried down here, and then you're going to have the balance carried down there. We are going to see how you put the balances. We are going to see how we put the balances as we do our question. But simply that is how you prepare a total debtors control account or a sales ledger control account. And now let's move on to a creditors control account. So a creditors control account is the same concept. If you have creditors, let's see here. This is the total creditors control account. Total creditors control account. So let me come back here to our creditor scenario. You had there the debtors. So a creditor is somebody you have bought goods from on credit. You have not paid them. So a creditor whereby we have not paid or an amount is owing is going to have a credit balance. Then some of the creditors who we have paid as the organization in advance, where some of the creditors have our money for goods that we have not yet ordered, our account there, those creditors is going to be a debit balance. If we purchase goods on credit, we are going to debit purchases. So I can open the purchases account here. Purchases account. So if you buy goods on credit, we are saying you are going to debit purchases, and then you are going to credit the creditor. So if you buy from creditor A, we are buying some goods. We are debiting purchases by the amount of goods, and then we are crediting the debtor. The creditor. So this is purchases. And so on. Again, for creditor B, the same. If we buy some goods from creditor B, we are going to debit purchases from creditor B. We are going to debit purchases, and then we are going to credit. We are going to credit creditor B. So this is the information that we want to combine into one control account. So what you see here is that some creditors will have a credit balance. Here are the creditors whose obligation is there, who we owe money. And then some creditors we have overpaid. Those creditors will have a debit balance. It is exactly the opposite of the debtors. Once we buy from the creditors and we do not pay credit purchases, we are going to credit the debtors account, and then we are going to debit the purchases. So taking us back, so to prepare the total creditors control account, we are going to bring the totals from the creditors account. So some creditors have debit balances. The creditors we have overpaid. Then we have some creditors here who have a a credit balance. This is the amount owing to the creditors. So we are saying the total here, whatever increases the obligation to the creditors is credit purchases. If we continue buying on credit purchases, we continue buying on credit, our amount or our obligation is going to continue increasing. But certain things can reduce the amount that is owing or the obligation that is owing to our suppliers. So those amounts that are owing to the suppliers can be reduced by payment to the suppliers. Payment to suppliers. Once we pay the suppliers, the obligation or the amount owing reduces. Once we return some of the goods, you can have returns outwards. Returns outwards. Once we return some of the goods that we had bought on credit, the obligation decreases. At the same time, once we give them some bills payable, the amount that is the obligation to the creditors, or the total obligation to creditors, is going to reduce. We can also have discount received. Once we get some discount from the suppliers, we get some discount from the suppliers, the obligation decreases. Again, we talked about contra entry, whereby an individual or a certain customer is also a supplier. So the organization supplies some goods to them, they also supply some goods to us. So we set off the debt as a contra entry. And we are saying, out of this obligation that is owing, if it is not paid in time, we may also be charged some interest. So we are going to add here interest on overdue account. So any interest on the overdue account is going to be charged there. So anything that reduces the amount or the obligation, we are going to debit. Anything that increases the obligation, we are going to credit. Now, we may also receive some refund. We may also receive some refund. Out of this money that we had overpaid, we may receive some refund from the suppliers. So if we get a refund, we are going to put it here, refund from suppliers. Refund from suppliers. We are saying this is an amount that was overpaid. So if you get any amount from this amount that we had overpaid, we may get a refund from the suppliers, which we are going to debit. So at the end of the day, we are going to have balance carried down on both sides. Balance carried down, balance carried down. So this brings us to a question. We can try to at least answer a question based on this information. So we are going to answer our question. The question reads, the following balances were extracted from the books of Cathay Limited for the month of April 2005. The debit balances on 1st April for the sales ledger and the purchases ledger are given, same as the credit balances. You have discount received, discount allowed, credit purchases, credit sales, return inwards, contra entry, cash payment to creditors, interest charged by creditors, checks received from customers, bad debts written off, customers' check dishonored, interest charged to customers on their overdue accounts, return outwards, and then you have the balances. That is the closing balances. You're given one balance for each account. You're supposed to look for the second balance for each of the two control accounts. So the requirement for this question is simply to prepare the sales ledger control account, which we have also called the Total Debtors Control Account, and to prepare the purchases ledger control account, or what we call the Total Creditors Control Account. And that is what exactly we are going to do from this question. Again, you can take a minute to record the question. It will also be attached to this video. So to answer our question, we can prepare the two accounts as follows. To answer our question, we are going to start by preparing the sales ledger control account. We are going to first of all identify the debit balance and the credit balance on this account. So our debit balance from our question is 1428,000. Then we are also going to identify the credit balance as given. The credit balance is 40,500. So We have already discussed that the item represented here on the debit side represents the amount that is owing from the debtors. And we have also said what increases the amount owing from the debtors is credit sales. So you can also identify the figure for credit sales. How much goods were sold during the year on credit to the customers, or collectively to all the customers, how much was the total credit sales? The total credit sales is given there as 200. And I love to post there for the debit side and simply come to the credit side now. Any amount or any item that is represented in our question that reduces the amount of money that is expected from the debtors, because the total now amount of money that we require from the debtors is the sum of how much was owing from them at the beginning of the period and how much the credit sales during that period were. So this is the total debt from the debtors. We are seeing what is going to reduce that obligation or that amount that is owing from these debtors. So from our question, we have given them a discount. So we have allowed them a discount. We are allowing a discount of 209,700. From our question again, we have some return inwards. Return inwards. So out of the goods that were sold on credit, the credit sales, some of the goods were sold, they were later returned by the customers. Maybe they were defective. So it is reducing the amount of debt that or the obligation from the debtors. So the return inwards is 75,000. We also have some contra entry, and I explained contra entry. So I will not do so again, but it is simply where instead of paying a supplier and the same supplier is one of your customers, you set off the amount that owes to each other. Here being 36,900, which is a contra entry. We may also receive some of the money, cash received from the debtors. Cash received from debtors or from customers. In our case, we received this money in form of checks. In our case, we received the money in form of checks, and we received a sum of that is a cash received from the debtors in form of checks. Some of the debtors to whom we sold on credit, some of them have been declared as bad debts. So we are going to write off the bad debts that are written off. We are writing off some of the bad debts, we here being 37,200, which is the amount of bad debts that is written off. Now, out of the entries here, we have seen that some of the checks here that were received, they have been dishonored. So we have to write them back. So here we are going to write back dishonored check. Dishonored checks. We had received them and credited the account. Now they have been dishonored, so we have to write them back, an amount totaling to 26,100. And because of not paying the debtors not paying their accounts on time, they have been charged some interest on the overdue accounts. So they have not paid up the debt in time. They are being charged interest because of non-payment in time. So interest charged to debtors. Interest charged to debtors. We are going to have here that the interest charged to debtors is 96,100 on their overdue account. I would also like to talk about the amount here which represents the overpayment by debtors. If some of the debtors come back for a refund, if we give them a refund, it would also be reflected here as a refund to customers. If those of the debtors who have overpaid, they come for their money or they come back for a refund, because we say this represents debtors who have overpaid their account. If they come for a refund, once we give the refund to customers, it would also be reflected there. So what we have remaining in this account is the balance carried down. We have been told in our question that the balance carried down for the sales ledger is a credit balance of 5070. For it being a credit balance, we are going to put it here in the debit side first as a balance brought down, carried down. And because it is a credit balance, once we get the total on both sides, the balance brought down is going to be on the credit side. So that the same 5070 is a credit balance. So inside here, below the totals, before the totals, it will be on the debit side. After the totals, it is going to be on the credit side because you have been told it is a credit balance. So that is how you're going to put it as a credit balance. Having this balance on this side, now we can look for the balance carried down on this side because we are only given one balance. In our case, we had been given this balance, this credit balance. I'm calling it credit balance because we name balances according to their balance brought down. So it is a credit balance. But inside below or before the totals, it was inside as a debit side. So once we compute all the amount on this side, because this is complete, this is a complete side, we are going to get 3,669,100. And we also want this side to also equal the same amount, which is 3,669,100. So we are going to subtract all the figures on this side and get our balance carried down here. Our balance carried down is 1691,800, which is our debit balance. So this is going to be our debit balance. So again, below the totals here, our debit balance is going to be 1691,800. And that is how our sales ledger control account looks like. And quickly, we can also look at the creditors ledger control account in the same manner. So allow me to add one column here for the creditors. So we are going to have creditors control account. Let me include the word total creditors control account. Like that. The process is the same. We are going to start by identifying the balances on both sides. We are going to identify the balance brought down on that side, and you also are going to identify here the balance brought down on this side. So in our question, we already know the balances. So we have a creditors control account. The debit balance is 10,500. This represents the amount overpaid to some of the creditors. Then we have the amount owing to our creditors, or the obligation that we owe as an organization to our creditors. That is this credit balance. And we said that this account is increased by credit purchases. If we continue buying on credit, the credit purchases are going to increase our obligation. So our obligation in the month increased by the credit purchases of 1,334,000. On the debit side here, we said we are going to identify the items that reduce the obligation. So what is reducing our obligation is the discount received. We are receiving a discount. Discount received. The discount received is of 142,500. We are also paying some amount to the suppliers. So cash payment to the creditors or cash paid to suppliers. Cash paid to suppliers. So during the year, the month, we paid some amount to the creditors or to the suppliers. That is 1159,200. We are not going to forget the contra entry. The contra entry, it has been over-explained in this video, which is 36,900. We are also going to have the returns outwards. Out of the goods we purchased on credit there, some of them we returned to the suppliers. Maybe they were defective. So the return outwards decreases our obligation by 26,700. And again, because of not meeting our obligation to the creditors on time, an interest has been charged. So there is an interest charge on overdue account. Interest charge on overdue account. So it is increasing the amount that is owing. The amount that is owing is increasing because we are being charged interest of 69,000 for all the overdue accounts. And then this again brings us to the total of the balances. We have only been given one balance. We have been given one balance, that is the purchases ledger debit balance. Being a debit balance, as we have discussed, we are going to first of all include it here. After which we are going to get the total on both sides. And because it is a debit balance, we are going to bring it to the debit side. So the debit balance is 14,400. That is the one we are given. So being given that debit balance, now we can look for the credit balance, the one on this side. By getting the total of all the items on this side, the total of the items is 1971,200. Once we get the total on that side, we are going to subtract all the items on this side, and the resulting amount is the balance carried down on this side. So the balance carried down here now is going to be 595,400. And this balance is the credit balance. So we are also going to write it on the credit side here as a balance brought down, which is 595,400. So once you have one balance, you use that side, which is now already fully without the information, to get the balance on the other side. So that is how you prepare the sales ledger control account, and also you prepare the purchases ledger control account. If you found this video to be useful, kindly like, share, and subscribe. Thank you.